Over 1 million international students study in the United States right now. Like millions of other young adults, they enter the financial system completely invisible. Lenders call them credit ghosts. You might think having zero credit history means you have a clean slate. In the US system, having no score is treated almost exactly like having a terrible score. Without that 3-digit number, you face high security deposits for a basic cell phone plan, apartment rental rejections, and outright denials for auto loans. Part of this traces back to a massive consumer protection law passed in 2009 called the CARD Act. Lawmakers wanted to stop banks from preying on college students, so they mandated that anyone under 21 must prove they have independent income to repay the debt or supply a cosigner over 21. Facing this barrier, young people typically make one of two choices. They either spend their first few years doing absolutely nothing, assuming credit builds itself, which it doesn't, or they try to build it fast and stumble into errors that cripple their finances for nearly a decade. The rules are hidden, but they are entirely mathematical. To survive, you have to look past the plastic cards and understand the algorithm calculating your worth. The most reliable backdoor into the system is a secured credit card. Instead of asking a bank to trust your non-existent history, you give them a small cash deposit, usually around $200 to $500. That deposit becomes your collateral and your exact credit limit. International students often lack a social security number, which halts traditional applications. But you can bypass this by applying with an individual taxpayer identification number, or by using services that translate your home country's credit history into a format U.S. lenders can read. Once you have a card, your behavior feeds into the FICO scoring model. This chart shows the 5 components that make up your score. Notice that a massive 35% of the entire pie is based on one metric: payment history. Do you pay on time every time? Many beginners get tripped up by the timing. If you miss your due date by 5 days, you get hit with a late fee. But the algorithm doesn't care yet. A payment is not reported to the credit bureaus until it is exactly 30 days past due. Crossing that 30-day threshold creates a derogatory mark. That single mark can shave 50 to 100 points off your score instantly, and it stays on your credit report for 7 years. But missing a payment isn't the most expensive mistake. That happens at the ATM. Pulling cash out of a machine using a credit card triggers what is known as a cash advance. Unlike buying groceries, a cash advance has 0 grace period. Interest begins compounding on day 1. You also pay an upfront withdrawal fee, and the interest rate applied to that cash is often much higher than your normal purchase rate. To protect this 35% chunk of your score from both late payments and soaring interest, there is one reliable defense. Set up automatic minimum payments the day you activate the card. Looking back at this chart, the second largest slice controls 30% of your score. This is credit utilization. Utilization is just the ratio of debt you have compared to your total limit. If you have a $300 limit on your secured card and you spend $200, your utilization is 67%. Scoring models begin penalizing you when that number exceeds 30%. Here is the trap. The credit bureau takes a snapshot of your balance on the statement closing date, which usually happens weeks before your payment is actually due. Even if you pay your bill down to 0 every single month, a high balance on the day the snapshot is taken tells the algorithm you are maxing out your credit. The model also dedicates 10% of your score to new credit. Every time you apply for a loan or a card, the lender checks your history. This is called a hard inquiry. New arrivals often apply for a phone plan, a retail store card, and a bank card all in their first month. Multiple hard inquiries grouped closely together signal financial distress to the algorithm, triggering application denials and dropping your score. Then there is the 15% of your score dedicated to the length of your credit history. After a year of responsible behavior, you will likely qualify to graduate from your starter secured card to an unsecured rewards card. The natural instinct is to cancel the old card. Doing that erases your oldest data point. Your credit age is an average of all your accounts. Shutting down the card you've had the longest artificially shrinks your credit history, and your score drops. The algorithm is designed to flag rapid changes in behavior. Maxing out limits, applying for multiple accounts, and abruptly closing old ones all read as risk. Mathematically, doing less yields a much better score. Your FICO score cannot be rushed. There is no rapid hack to reach an 800 in a single semester. Building a robust credit profile from a completely blank slate reliably takes 12 to 24 months. Time is a fixed variable in the equation. Keep your running balances below 30% of your limit. Automate your minimum payments to block late fees. Never withdraw cash from an ATM on credit. And leave your oldest accounts open, even if you just use them for a single cheap subscription. It takes years of boring, repeated actions to convince lenders you are safe. But because the system is cumulative and unforgiving, a single error can erase months of progress, forcing you to pay significantly more for housing, cars, and loans when you need them most. In the invisible game of U.S. credit, patience and consistency are the only strategies that work.